Good afternoon, everyone, and welcome to the OBR's first in-person press conference since before the pandemic. I'm Laura Gardner, I'm Deputy Chief of Staff at the OBR, and I'll be chairing today's event. I'm joined by the three members of the Budget Responsibility Committee, the Chair, Richard Hughes, along with Professor David Miles and Andy King. In a moment, Richard will run us through a summary of the forecast that we've just published, after which the committee will take questions both from those here today and those joining us online. If you're in the latter camp, you can submit questions at any time via Slido, which you can access via the link on our website. And we'll try to get to as many of them as we can. But first, let's hear from Richard.
Thanks, Laura, and good afternoon, everyone, and thank you for joining us here at the Institute for Government and online. I'm going to take you through the highlights of our latest economic and fiscal outlook before we open it up to your questions. And the slides and speaking notes from this presentation can be found on our website. Let me start by thanking the staff of the OBR, Treasury, and across government for their expertise, flexibility, and perseverance in putting this latest forecast together. Like all of our forecasts over the last 2.5 years, this forecast was prepared against the backdrop of an extraordinary degree of volatility and uncertainty. However, unlike those previous forecasts, some of that uncertainty was homegrown, with successive revisions to the timetable, process, and direction of fiscal policy. One relatively minor consequence of this disruption is a shorter EFO document than usual. Specifically, we've had to keep the document to 63 pages, rather than the 200 plus that we usually produce. While some of you may regard this as an improvement, I can assure those of you who might be concerned about a loss of transparency that the wealth of spreadsheets and databases that accompany a full-length EFO will still be available on our website, many of them today, and the rest to follow over the course of next week. And I can also assure you that all of the analysis, conclusions, and numbers behind those charts and graphs you see in the document continue to represent the independent judgments of Andy, David, and myself. Let me now turn to the content of our latest forecast, starting with three key developments that explain most of the changes in the outlook since our last forecast in March. The most important economic development since our last forecast has been the deepening of the European energy crisis, precipitated by the Russian invasion of Ukraine. The further reduction in Russian gas imports, the rush to fill up gas storage before the winter, and the damaging of the Nord Stream 1 pipeline drove wholesale gas prices in Europe to new highs over the summer. As shown in the blue line on the right, our economy forecast is conditioned on market expectations for gas prices over the next 3 years, which we then hold constant in real terms in the final 2 years of the forecast. Based on the average of the futures curves over the 3 days to the 26th of October, gas prices are expected to reach a peak of around £3.70 per therm in early 2023, and are roughly double the level of our March forecast over the year. Prices then fall back to around £1.90 per therm in the mid-2020s, which is still 4 times higher than we were used to before the pandemic. The government's energy price guarantee limits average household energy bills to £2,500 this winter and £3,000 next winter, insulating households from the even larger increases in energy bills that they would have faced. A similar scheme that limits the increase for energy costs for businesses is in place until March. However, these schemes do not change the price of energy in the medium term, so sustained high energy prices act as a drag on productivity and potential output, as we explored in our fiscal risks report over the summer. As inflationary pressures have built up, market expectations for the rise in the Bank of England's policy rate, shown on the left, have also risen, from a peak of around 2% in our March forecast, shown in green, to around 5% in the print of the curve used in our latest forecast, shown in blue. As you can see from the chart on the right, longer-term interest rates on UK government debt have also risen dramatically, and are now 2 to 3 times higher than we expected in March. The gilt rate curves used in our fiscal forecast, shown in blue, were taken in the first 10 working days of Rishi Sunak's prime ministership, starting on the 24th of October, and see yields peak at just under 4% at the 20-year mark. As you can see from the yellow lines, interest rate expectations have come down somewhat since the market convulsions that followed Kwasi Kwarteng's growth plan on the 23rd of September, which saw 20-year yields rise to 4.5% the following working day. And while some of that late September spike in yields reflected an increase in the interest rate differential between the UK and other sovereigns, that increase in spreads had all but disappeared by the time we finally closed our fiscal forecast. In addition to these largely external influences, fiscal policy here at home has also been a key source of uncertainty since March. The past 6 months have witnessed a series of dramatic swings in the direction of fiscal policy, with 5 major fiscal statements delivered by 3 successive governments. This chart illustrates the cumulative effect of those statements on government borrowing over the next 5 years. starting with then Chancellor Rishi Sunak's 26th of May cost of living package, which added £9 billion to borrowing in this financial year, with savings in subsequent years from the new energy profits levy. Fast forward to the 8th of September, and then Prime Minister Liz Truss's original energy price guarantee and equivalent support for businesses added £70 billion to borrowing over the next 2 years. To this large near-term loosening, the personal and corporation tax cuts in then Chancellor Kwasi Kwarteng's 23rd of September growth plan would have added a further £48 billion to borrowing over the medium term. But almost all these tax cuts were reversed in Chancellor Jeremy Hunt's statement of the 17th of October, with the main survivor being the ditching of the health and social care levy, which brought the net medium-term loosening down to £21 billion by 2027-28. And finally, today's autumn statement delivers a further package of net tax rises and spending cuts, which reduce borrowing by £62 billion by 2027-28. And taken together, and including their indirect effects via the economy, the net impact of this series of announcements and reversals has been to add over £40 billion to borrowing this year, and then take almost £40 billion off borrowing by 2027-28. Those three big movements in energy markets, interest rates, and government policy since March all have big implications for the economic and fiscal outlook over the next 5 years. And let me start with their implications for inflation. We now expect inflation to peak at 11.1% in the fourth quarter of this year, driven by higher global energy and food prices in particular. That's 2.5 percentage points higher at its peak than we forecast back in March, but the peak is 2.5 percentage points lower and 1 quarter earlier than it would have been without the energy price guarantee, as illustrated by the dotted line on the chart. Inflation is then expected to fall back sharply over the course of the next year and is dragged into negative territory in the middle of the decade, before returning to its 2% target by the end of the forecast period. But in the near term, inflation far outpaces growth in nominal wages, which are expected to grow by 6% this year and 4% next year. This drives historically large falls in per-person real disposable income, which dropped by a cumulative 7% over the 2 financial years to 2023-24, wiping out the last 8 years of improvement. This steep fall in living standards happens despite the energy price guarantee and other government support, which raised real incomes by 3.5% on average this year and next. However, for a net energy importer like the UK, the huge increase in global gas prices over the past year represents a terms of trade shock that leaves our country as a whole poorer. So while government policy can, through spending, taxation and borrowing, alter who in the UK pays for these high energy costs within and between generations, it cannot make them go away. Indeed, we expect real incomes in 2027 to still be 1% below their pre-pandemic peak of 3 years ago. This squeeze on real household incomes drags down consumption and tips the economy into a recession, lasting just over a year from last quarter. Peak to trough, real GDP falls by just over 2%, but it would have fallen half as much again in the absence of government support. This fall in output is much shallower than those experienced during the pandemic or the 2008 financial crisis, but similar in depth to that seen during the recession of the 1990s. High energy cost, interest rates, and corporate taxes also reduce business investment over the next few years, with longer-term implications which I'll come back to in a few slides. This weaker output, combined with the downward revisions to outturn data over the last 2 years, mean that real GDP doesn't return to its pre-pandemic level until the end of 2024, and remains over 3% lower at the forecast horizon than we expected in March. Turning to the implications for the labour market, the recession leads to another modest spike in unemployment, seen on the left, which peaks at just under 5% in the third quarter of 2024, before falling back to its assumed structural rate of just above 4% by the late 2020s. More worrying for the long-term health of the UK economy has been the continued rise in the number of adults classed as inactive or outside the labour force since the start of the pandemic. As shown on the right, this means that the overall size of the labour force has shrunk by around 300,000 people since the pandemic. And while we assume that some of these currently inactive will eventually rejoin the labour force, the prevalence of older people in this group suggests that many never will. And the net result is that the overall employment rate of the adult population is around a full percentage point lower by the end of the forecast period than on the eve of the pandemic. This brings me to our latest estimate of potential output, or the supply side of the economy, which has attracted particular attention in the run-up to this forecast. Our forecast for growth and potential output, shown in the middle of this slide, is lower in the near term but unchanged at the end of the forecast compared to March. However, as you can see from the chart on the right, the composition of that growth has slightly changed to reflect a number of largely offsetting developments in the drivers of potential growth since March. First, we revised up our estimate of the labor supply growth to reflect continued high levels of immigration since the introduction of the new post-Brexit migration regime. Second, we revised down our estimate of the contribution of capital deepening to reflect the impact of the recession and a higher cost of capital on the volume of business investment. Third, we revised down our estimate of growth in measured productivity to reflect the consequences of higher energy prices. All in all, that leaves our assessment of the rate of growth and potential output of the forecast horizon unchanged at 1.75% a year. This medium-term growth rate is, as you can see from the chart on the left, a full percentage point lower than the average growth in the decade prior to the financial crisis, and one-third of a percentage point below the post-financial crisis average. But despite that, our forecast for actual growth in the medium term remains slightly above that of other independent forecasters. And for all those wishing to know even more about how we produce our potential output forecast, we published a briefing paper on this topic alongside today's EFO. Let me now turn to the latest fiscal outlook, taking account of the more challenging economic backdrop over the next 5 years and the net result of the array of fiscal policy announcements over the past 6 months. Having fallen from its post-war peak of 15% of GDP at the height of the pandemic to below 6% of GDP last year, borrowing is set to rise again this year to just over 7% of GDP, before falling back to just over 2% of GDP by 2027-28. In cash terms, borrowing is nearly 80% higher this year, and almost 80 billion pounds higher this year, and almost 40 billion pounds higher in 5 years' time than we forecast in March. To understand what drives this deterioration in the fiscal position, this chart breaks down that increase in cash borrowing into first, differences arising from underlying forecasting changes, shown in shades of blue. Second, changes arising from the net effect of policy decisions, shown in red for spending and yellow for tax changes. And third, the indirect or second-round effects of these policy changes via their impact on the economy and the debt interest paid on new borrowing, shown in purple. Starting with the blue, underlying forecasting changes add on average £55 billion to borrowing in each of the next 5 years. 3 large changes dominate this: higher interest rates adding to debt servicing costs, higher inflation and inactivity adding to welfare spending, and a weaker economy weighing on receipts. Looking at the effect of policy changes, the May and September cost of living and energy packages add around £60 billion to spending this year and around £25 billion to spending next year. Cuts in departmental spending plans over the remaining 3 years save around £30 billion in the final year of the forecast, with 3/5 coming from current budgets and 2/5 coming from capital budgets. Tax changes cost money next year, but raise money in the final 4 years, as the revenues lost from scrapping the health and social care levy are more than offset by increases in other taxes, with a net yield of £8.5 billion in the final year of the forecast. Indirect effects reduce borrowing materially in the near term by supporting incomes and lowering inflation, but raise borrowing modestly after that due to debt interest costs and fiscal consolidation weighing on economic activity. Taken together, these changes leave the level of borrowing around £85 billion higher in the next 2 years and around £40 billion higher in 5 years' time. Where does all this leave levels of taxation and expenditure in 5 years' time? The tax burden set to rise from 33% of GDP before the pandemic in 2019-20 to over 37% of GDP in 2027-28, which is around 1 percentage point higher than we forecast in March, and its highest sustained level since after the Second World War. This higher tax burden pays for a larger state, whose expenditure rises from 39% of GDP before the pandemic to 47% of GDP this year, before falling back to 43% in 5 years' time. This leaves public spending around 3% of GDP larger than we forecast in March, and its highest sustained share of the economy since the 1970s. This increase in the overall size of the state over the medium term is driven by a combination of higher inflation and interest rates, which push up the cost of the government's inflation index welfare commitments and servicing its higher stock of debt. And these increases more than offset the cuts to departmental budgets in the final 3 years of the forecast, leaving overall government spending higher in cash terms, and more importantly, as a share of an economy made smaller by the energy price shock. This slide looks in more detail at the implications of those reductions in departmental spending beyond the current spending review period, ending in 24-25. At the time of our March forecast, the total envelope for departmental resource or current spending or current expenditure was expected to grow at around 2.5% in real terms from the middle of the decade. This resource envelope was sufficient to allow the government to meet an array of medium-term spending commitments and pressures, including growing health spending by 3.1% a year in real terms, continuing the underlying growth rate in health in the current SR period, growing defense and overseas aid spending in line with GDP, and holding core school spending per pupil constant in real terms. And this would have left sufficient resources for the budgets of all other government departments to rise by 2.8% a year in real terms in the next SR period. But the removal of £18 billion from the resource envelope by 2027-28 in this autumn statement means that total spending now only grows by 1% a year in real terms over the next spending review period. And meeting the aforementioned pressures and commitments in health, defence, aid and schools within the smaller envelope would now apply a real terms cut of 0.7% per year in the remaining spending. While significant, cuts on this scale are smaller than those planned in SR10 and SR15, which planned real cuts of 5% and 3% for such unprotected departments. However, one needs to bear in mind that it's this same group of departments that have borne the brunt of successive real cuts over more than a decade, and that the base from which the next squeeze will apply in 2024-25 has already been squeezed by the decision to not reopen the cash limits set in the October 2021 spending review to compensate many of these departments for much higher inflation in the meantime. So while we consider the revised path for public spending beyond the current SR years to be plausible, it's not without risks, as we spell out in the EFO. Turning to what this implies for the stock of debt. Compared to our March forecast, headline debt is higher as a share of the economy in every year, and by 17% of GDP in the final year. Including the net debt of the Bank of England, it rises from 97% of GDP last year to a peak of 107% of GDP in 2023-24, its highest level in 6 decades, and then falls over the remaining 4 years of the forecast. But this path is somewhat distorted by the repayment of around £150 billion of loans issued by the bank's term funding scheme. Excluding the bank, underlying debt rises from 84% of GDP last year to a peak of 98% of GDP in 2025-26. And then falls modestly over the final 2 years of the forecast. This higher stock of debt, coupled with much higher interest payments, means that the share of public revenue being consumed by interest payments has risen dramatically since the spring. We expect debt interest costs to rise from under 5% of revenues in 2019-20 to 8.5% of revenues in 2027-28, having spiked to a post-war high of 12% this year. It's not just the scale, but also the speed at which higher interest rates and inflation have pushed up debt servicing costs that's a warning to this and future chancellors. As we've underscored in successive reports on fiscal risks, 3 developments in recent years have greatly increased the sensitivity of the public finances to changes in borrowing costs since the start of the century. The first is the increase in the debt stock itself, which has almost quadrupled from the 28% of GDP that it was in 2000-2001 to 102% of GDP by 2022-23. The second is the associated rise in inflation-linked debt, which has risen from 6 to 22% of GDP, and for which any inflation surprises directly increase the stock of debt rather than erode its real value. And the third is the shortening of the effective maturity of that debt as a result of the quantitative easing operations of the Bank of England. This has reduced the medium-term maturity of debt of the consolidated public sector from 7 years in 2008 before QE to less than 2 years now. The combined effect of all these changes has been to leave the public finances much more exposed to interest rates and inflation movements than before. And to illustrate this in today's money, every 1 percentage point rise in short-term interest rates now adds £13 billion of debt interest costs the following year, rather than just £2 billion if we had the same debt level and structure as in the year 2000. The heightened sensitivity of the public finances to higher inflation and interest rates more than explains why government has missed both of its currently legislated fiscal targets. Set by then-Chancellor Sunak last October, they included targets to get underlying debt falling as a share of GDP and balance the current budget 3 years into the forecast, 2025-26 in this forecast. These legislated targets are set to be missed by £11.4 billion and £8.7 billion in this forecast. But as he deals with the fiscal consequences of this energy shock, the current Chancellor has proposed a new set of fiscal targets in his autumn statement. The first rule is to ensure that underlying debt is falling after 5 years, rather than 3. In the absence of new policy measures, he was on course to miss this target by £28.9 billion. With them, he's met it, with £9.2 billion to spare. The second rule is to bring overall borrowing below 3% of GDP by the end of the forecast. Pre-measures borrowing was set to be 3.7% of GDP. Post-measures, it's 2.4%, meaning this target is met with £18.6 billion to spare. But the margins by which these new targets are met are historically small, and the risks around our forecast right now are large. The outlook would be considerably brighter were a rapid end to Russia's war in Ukraine to stabilize European energy markets, reducing pressures on inflation and interest rates. That could also spur investment and productivity growth over the medium term and get debt falling faster. But should the Ukraine war last longer and higher energy prices and inflation persist, there are several downside risks to worry about. Energy-related support to households and businesses, much like the furlough scheme during the pandemic, could prove difficult to withdraw as their deadlines draw closer. Other supposedly one-off measures, such as the temporary business rates relief for the retail and leisure sectors and the Household Support Fund, are now heading into their fourth years at a cost of over £3 billion next year. Inflation is putting pressure on departmental spending. £8.5 billion has been found this autumn statement to top up health, social care and schools budgets in 2024-25, but other departments face a reduction in real-term spending power of between £5.3 billion and £15.3 billion, depending on your choice of inflation index. And next April's planned super-indexation in fuel duty is assumed to bring in £5.7 billion in revenue next year in our forecast, but would now require a rate increase of 23%. In summary, rising energy prices, inflation and interest rates have taken the wind out of a UK economy which had not quite regained its pre-pandemic level and tipped it into a recession we expect to last for just over a year from last quarter. Inflation is expected to peak at 11% this year, but would have peaked 2.5 percentage points higher without the energy price guarantee. Despite the government spending more than £100 billion over the next 2 years to cushion the resulting financial squeeze on households and businesses, we expect a record 7% fall in living standards over the next 2 years. These largely global forces are putting pressure on the government finances and would have seen underlying debt on an ever-rising trajectory in the absence of further policy action. To bring growth in debt under control within 5 years, the Chancellor's announced £30 billion in tax rises and £30 billion in spending cuts in this autumn statement. But this still leaves the stock of government debt £400 billion higher in 5 years' time than we assumed in our forecast back in March. And the more than doubling of interest rates in the meantime pushes the share of government resources consumed by the cost of servicing that debt to its highest level in a generation. This leaves the UK public finances more sensitive to movements in interest rates than they have been for decades. When these rates move in the government's favour, the fiscal outlook can improve by large sums. By way of illustration, movements over the past week and a half alone would add around £10 billion of the headroom against the Chancellor's goal of getting underlying debt falling relative to the market expectations in our forecast. But it also leaves the public finances more vulnerable to sudden shifts in market sentiment, a foretaste of which we had a few weeks ago, and to which the near doubling of debt interest costs between March and our forecast attest. And with that, I'll now hand things back to Laura, who'll be chairing the question and answer session. Thank you.
Okay, thank you, Richard. So I think we'll reward those who've ventured here in person and start with a couple of questions in the room. If you could please wait for the microphone to get to you and tell us who you are and where you're from, if you so wish. We'll start with this lady here, Chloe.
Hello there, it's Anna Isaac from The Guardian. A couple of questions. First, could you clarify why the cost of taking of a bulb has risen so significantly? It's a very sharp increase in the cost. It's mentioned in a couple of the footnotes. And secondly, how credible is the 61.7 billion tightening in 2027-28? Obviously, it's important to determine, the policy is up to the politicians, whether or not it is to an extent deliverable and realistic in terms of fiscal responsibility. Thanks very much.
Can I ask Andy to take the bulb question and then we'll come to Richard on the second one?
Yes, certainly. The cost of the bulb intervention has increased essentially because it lasted for more months than was factored into the March forecast. So the transfer to Octopus has happened, I think, 6 months later, and that the loss that was incurred operating bulb in between those two time periods is the additional cost.
Is that because they weren't allowed to hedge in the interim? Or?
I can't offer you further detail, but that it's the monthly running loss of bulb. That.
Thank you very much.
Thanks, Andy. And Richard, on the credibility of the medium-term tightening.
I'd say there's always varying degrees of uncertainty around the likely outturns against our estimate of the impact of different policy measures. And as I alluded to in my remarks, some policy measures we have to, by law, put into our forecast, like the fact that fuel duty is going to rise in line with inflation, despite the fact that every single chancellor always announces, with a few exceptions in the recent past, that fuel duty gets frozen. On this particular occasion, there is a super indexation of fuel duty because it is RPI plus 3, I recall, RPI plus 5, sorry, on top of what is going to be a very high RPI number this year. And that's why it brings in 23% worth of revenue. But there's also several £billion that if he doesn't go ahead with the indexation would come off that headroom number. On the spending side, at the moment there are these spending plans sort of penciled in beyond the current spending review period, but it has also been a sort of well-established pattern of Chancellor's past to pencil in lower growth rates of spending before a spending review happens, but then as that spending review draws nearer and you have to make the tough choices of allocating that money out, Chancellors have tended to add 20 billion, 30 billion pounds to the overall envelope in order to make their lives a bit easier when it comes time to divide up the money between departments. I'm not saying this Chancellor is going to do that thing or whoever is Chancellor doing the next spending review going to do that, but it has been a pattern of behaviour that Chancellors tend to win the day when you're setting overall envelopes of spending reviews that aren't going to happen until several years hence. As those spending reviews draw closer and your cabinet and your cabinet colleagues start to collar you in the corridors, and you need to agree things with the Prime Minister and the cabinet as a whole, it gets much harder, and money gets chucked into those envelopes to make life easier.
Thanks, Richard. Do we have any more in the room? To this gentleman here, please.
Jack Barnett from City AM. Just a couple of questions. The first one on clarification. You've got the debt interest burden hitting an all-time high. In terms of the pace of rise, is that also rising at a record pace? And then the second question is, you obviously mentioned there that public finances are more vulnerable to shocks in financial markets. I kind of flip it round and say, are financial markets now almost looking at us very intensely, both on how we reduce our deficit and also whether or not we can get out of this low growth malaise that we've been in for a few years now?
Thanks, Jack. I'm going to ask Andy to come in on the first of those and David in a second on the second of those, if that's right.
So I don't know for certain, but I would be amazed if it's not the fastest rise. It's in the short term, it's very, very heavily influenced by RPI inflation, which went from very low to obviously very high right now. So as much as £75 billion worth of the debt interest spending in this fiscal year is on index-linked debt.
Thanks, Andy. And David on financial markets.
Yes, I think you're right. There is more focus in financial markets on the outlook for fiscal policy, and I don't think it's just in the UK. And it's partly because the stock of debt is so much higher than it has been in the past, and it's on a rising trajectory both here and in most other developed economies. I think there's also partly because of the inflationary effects, largely due to energy and gas prices and other commodity prices, a natural increase in interest rates in nominal terms that obviously adds to debt service costs, and perhaps also a perception now in the bond markets that one might have been living in a sort of false paradise for much of the last 10 years, where both in nominal terms, but particularly in real terms, people were willing to lend money to governments at extraordinarily low interest rates. I'm sure you'll know that if you take the index-linked bond yields in the UK, which is a good measure of the real return that people will get if they lend money to the UK government, until relatively recently, they were about minus 2.5%. So people were willing to lend to the UK government and lose 2.5% in some sense of what they lent every year. And were willing to do that on bonds that had 40 years still to run. And they were doing that with other countries as well. And I think there's a realization that that's not a very good deal in a sense to bondholders. So I think the new reality is that real interest rates will be higher for governments to borrow pretty much across the world. And because the stock of debt is so much higher pretty much across the world, government debt, there is a bit more focus on how affordable is that and what are the risks of not getting your money back. So I think that is going to be with us for quite some time.
Thanks, David. We're going to switch to a couple of online questions and I will come back to the room. There's 2 or 3 that are grouped together all on the same topic. An anonymous caller asks, any thoughts on why your forecast is more optimistic than the Bank of England's? Gurpreet Nawan asks, the Bank of England cautioned that improbably high market projections had distorted its forecast. Are your own forecasts, being conditioned on market rates, not affected by this same issue? And another anonymous person asks, how does your path for energy bills compare with that assumed by the Bank of England? So 3 questions on the differences between our forecast and the Bank of England's. I'll come to you first, David.
The Bank of England's forecasts were made a little while ago, and my recollection is that they were conditioning on market expectations of their own bank rate, which were a bit higher than we have right now, and that we've conditioned on. We've taken, for the fiscal forecast, we've taken market projections of where the bank rate will go from early-ish in November, a few weeks ago. The Bank of England, I think, were using a few weeks before that. So that's one factor. I think part of the reason, incidentally, why market rates came down a bit was because of the Bank of England's own forecast, which, in a sense, confirmed a belief that maybe market expectations as they were back in the middle part of October, which is for bank rate to get to 6% or so, weren't really consistent with the likely projection of what was going to happen to inflation. So we've used a marginally lower projection for short-term interest rates than the bank did. That will have a little impact, probably not a whole lot, on our forecast relative to theirs. I think a bigger reason, a more significant reason why our forecast is a bit more optimistic than the bank's is that we think it pretty likely that the savings rate of the household sector in the UK will fall very substantially, perhaps even close to zero, having been very high in the unusual circumstances of 2020 and 2021 during lockdowns when it was difficult for people to spend money. We think people are likely to dip, those that can anyway, dip into some of the excess savings they made back then. And that means that the projection we have for consumer spending is a fair bit stronger than the Bank of England. So I think those 2 factors are the major ones behind a slightly stronger forecast that we have than the bank. On the issue of whether or not we're in using the market profile, we may still be overestimating the likely path for bank rate. Well, that will depend. It will depend on how things play out to some extent. It is true that our forecast for inflation, based on market profile for interest rates, which is to get up to about 5% or so for a short while and then come back down to 4% and dip beneath it a few years further out than that, our forecast for inflation based on that does drop off very sharply 18 months or so down the road and falls into very mildly negative territory. Now, one might think that that suggests that we're using an unrealistic path for bank rate. I'm not so sure on that, because I think the Bank of England is likely to look through temporary very high inflation and temporary very low inflation in setting monetary policy. So just as the Bank of England is not now setting an interest rate to try and bring inflation back to 2% by Christmas, because if it did, interest rates should have to be about 9% probably. It's not implausible that if inflation temporarily dips beneath the target, even becomes slightly negative for a while, but then gets back to the target, they're not going to cut interest rates into negative territory just because inflation is sitting under the target. So I think our forecast is really conditioned on a plausible behavior of the members of the Monetary Policy Committee, which is they to some extent see through very sharp overshoots and undershoots of the inflation target and think where underlying inflation pressures are.
Thank you, David. We better come back to the room. I think we've got one person over here, Chloe.
Thank you, Rob Merrick from The Independent. Can you point me to any distributional analysis across the income scale that you've done as a result of the various ups and downs over the last 6 months? I haven't seen it yet.
We don't typically produce distribution analysis as part of our forecast. The Treasury does produce its own distributional analysis as part of their own documentation, and it's either in here or it's online. I mean, we do take account distributional effects where we think they're relevant to our macroeconomic forecast, and partly coming back to David's point about looking at the impact of higher inflation on households and also higher interest rates on households, the distributional impact of those things across different kinds of households really matters, because some households have savings. They may financially benefit from the fact that interest rates are higher. They're getting a higher rate of interest on those savings. Households that have no savings and just mortgages, they are likely to face financial costs from having higher interest rates on those mortgages once they reset to the higher rate. So we do take that into account to the extent to which we think it affects the behaviour of households as a whole and their consumption behaviour, because that's what drives our economic forecast, and it has some implications for our fiscal forecast. But as a matter of course, we don't produce distribution analysis because in the end we are a macroeconomic forecaster. There are lots of great institutions in this country who do produce distribution analysis. The Treasury does its own, but we don't produce it as a matter of course.
Thanks, Richard. Do we have any more in the room? We'll go to this one.
Paul Wallace. In the 2020 budget, the OBR anticipated lower capital spending than the Treasury envisaged. I can't remember the precise number, but I was wondering how that had worked out and is working out in practice.
I think it might be the other way around, in that it was higher capital spending, I believe, that was announced in the March 2020 budget that we had programmed into our forecasts. Public investment went up by quite a bit in Rishi Sunak's first budget.
Do you mean that we assume less is actually spent?
Oh, I see.
Yes, that has largely come to pass, not precisely, but the plans are never spent 100% because running that close to the line is dangerous for accounting officers in departments, because if you cross it, you have to explain yourself to Parliament. The very sharp rises in capital spending that were announced in March 2020, we thought would be difficult to get out of the door that quickly just because of the real world constraints on planning and delivering capital spending. So that did happen. Then there were sort of big complications through the pandemic with supply chain disruptions and the like. So yes, they have come to pass, but not in precise numbers.
Thanks. We'll go to a couple more online now. We've got at least 3 questions on the same topic. Martin Woodhead asks, what has been the impact of Brexit? Marion asks, what impact does Brexit have on the situation currently and going forward? And Shirley Cameron asks, what is the impact of Brexit on stifling market activity and reducing competition, which has worsened inflation? How has this been accounted for in the OBR forecast? I don't know if Richard or David would like to take this.
I mean, since the referendum, our forecasts have been premised on an assumption that over time the UK's departure from the European Union reduces the level of potential output of the UK by around 4% after 15 years. That was premised on the assumption that being out of the EU would reduce the trade intensity of the UK economy, so its degree of openness to the outside world. What we've seen so far in trade data bears out those assumptions. Trade intensity is falling over time and has been doing so since we put those assumptions into our forecast. It's something which we keep track of, but it is something essentially sort of baked in to the numbers that you see. We don't make any specific adjustment to our inflation forecast to identify or account for Brexit effects. We basically take the data as it stands and do it in a fairly standard way.
Thanks very much. We'll take one more online and then I'll check if there's any more in the room. An anonymous person says, can you maybe explain why the economy is expected to grow so much higher than its potential growth in the medium term, i.e. the back end of the forecasts? And we have a sort of similar question, also from Anonymous. What can account for the sharp acceleration in growth from 2024 to 2025? David, would you like to come in on that?
Yeah, I mean, what happens in our forecast, and I think what's likely to happen in the world, which is more important, is that in the very near term, it's going to be a year of squeezed budgets for households. Companies probably won't be doing as much in investment. We're still dealing with this huge increase in energy costs and interest rates going up. So quite likely, we have a year of mildly declining GDP. And that opens up an amount of spare capacity in the economy, which means that we move from a situation which we've been in recently of, in some ways, demand running ahead of the supply capacity of the UK economy, and that flips over to output falling and therefore the supply capacity of the economy actually becomes ahead of the actual level of GDP. And in the second half of the forecast, even though we're not predicting some bonanza growth rate in the productive potential of the economy, because you start out a couple of years from now with some spare capacity, as you get back to a more normal situation 4 or 5 years down the road, the growth rate of GDP in that second half of the forecast can be a bit faster than the growth of potential output because you're starting out with some slack in the economy. So that's the kind of mechanics of how the forecast works. I should just add that we have a forecast for the underlying growth of the potential of the economy, which toward the end of the forecast horizon is that potential output grows at about a bit less than 2%, 1.75%. That's mildly more optimistic than what we've seen in the 10 years or so after the financial crisis, which is a truly dismal decade for UK growth. But it's quite a lot short of the rates of growth of potential output of the economy that we saw in the 10, 15 years leading up to the financial crisis. So you could either describe that forecast of where potential output is growing at the end of our forecast horizon as optimistic relative to the dismal 10 years after the financial crisis, or pessimistic relative to the 10 or 15 years before it. I hope we're right in describing it as a sort of sober and realistic forecast.
Thank you. Do we have any more in the room? We have tons online, if not. Okay, I'll permit you one more, then we better go back to online.
I think I'll do better than my first question. Can I just ask you about net migration? So your forecast here is that it will decline between 2023 and 2026, but you seem to be saying that both of those figures are significantly higher than you were forecasting only 6 months ago because of a big increase in visas in the post-Brexit regime. Can you say any more about why your forecast would have changed so much over the last 6 months?
And I'm just going to add a very similar question from Ben Chew from BBC Newsnight online, who says, what impact does your upwardly revised net migration estimate have on your medium-term GDP growth forecasts and on the public finances? So 2 questions on migration there.
Yeah, so we don't produce our own forecasts for migration. We rely on the ONS's projections for net migration. And so we anchor ourselves to one or other of those projections. Up until now and up until this forecast, we've been using the sort of lower variant of the ONS's net migration forecast as a medium-term anchor for where we thought migration was going to get to in 5 years' time. And the ONS's lower net migration projection went down to 129,000 net migrants per year, and in our previous forecast, we had migration falling down to that lower number after the 5th year of the forecast. Having looked at the migration data since the introduction of the new post-Brexit migration regime, which came in at the same time as the pandemic hit, so it was quite hard, A, to understand what was going on because migration flows were disrupted by the pandemic, but B, was hard to understand because the actual data was disrupted by the pandemic. That person standing with a clipboard at Heathrow Airport asking, whether you're here to stay, whether you're just here to visit, wasn't there for much of the period for the pandemic and for good public health reasons. But it also meant that migration data was very hard to interpret during that period. So that said, the latest figures from the ONS in the year to June were that net migration was 239,000 people in the 12 months to June of this year. That leads us to believe that the new post-Brexit migration regime is just leading to a higher steady-state level of migration than we expected. And for that reason, we revised up what we think to be the sort of steady-state level of migration in our forecast from the ONS's lower variant, which is based on 129,000 migrants coming into the country, up to their sort of central variant, which is 205,000 people coming to the country. That does have some benefit to potential output. I think I showed you my chart. It adds about 0.1% to overall growth and potential because we assume that they have the same level of participation in the workforce as their equivalents already here in the UK. In terms of its fiscal implications, I'm not sure we separately model it, that we think of migrants as being sort of different fiscally from British residents, but Andy would know better.
Yeah, so we didn't separate this out. So in broad terms, 0.1% a year on growth for 5 years gets you 0.5% over 5 years, and 0.5% of revenue is about £5 billion. So it's a relatively small effect. Particularly, it's small relative to the cost of the energy crisis on potential output in this forecast.
Right, I'm going to go back online now. We've got 2 or 3 questions on inflation, or indeed deflation, so I'll probably come to you first, David. Arthi Nachiappan asks, what is the main cause of deflation in your projections? Someone else asks a similar question. Is it accurate to say that you assume deflation from mid-24? Any reason why you are so optimistic that inflation will correct so quickly? Certainly more optimistic than market-implied RPI or even the Bank of England. And if you can bear with me for one further inflation one, David, and then I'll let you speak. Carsten Jung from the IPPR asks, why is your inflation outlook significantly lower than that of the Bank of England, even though your growth outlook is stronger? And I will repeat any bits of that if you didn't quite get it all.
It's true that our forecast for CPI inflation, not RPI inflation, CPI inflation, as it dips down close to zero, then actually falls beneath zero by a very small amount and sits there for quite a sustained period, several quarters. Why does that happen? Well, it happens really because it's the flip side of what one of the major causes of why inflation has risen so much over the last several months and has risen to 11%, which is cost of imported goods, in particular gas, oil, and what that's doing to energy prices for households and to companies for that matter. And we use the forward curves, which give you a kind of market expectation, if you like, of where gas prices and oil prices are going. And they fall off quite significantly from the current close to the peak levels as you go forward 2 or 3 years. So we assume that that's what's going to happen to energy prices. So instead of energy prices driving up inflation very sharply, they drive inflation down quite sharply. In fact, even if energy prices just didn't change, then the increase would kind of fall out of the year-on-year price level comparison, and therefore the inflation rate would drop back. But actually, the forward markets for those for oil and energy, gas in particular, imply that they're falling. So that's the story behind inflation falling to really rather low levels and being sort of marginally negative. Instead, it's only negative on CPI. RPI inflation tends to be materially higher than CPI inflation, and so the RPI forecast I don't think would dip negative and sit there for any period probably on an RPI inflation. Why are we somewhat more, I suppose you could call it optimistic on the path of inflation than the Bank of England? I mean, in a sense, that's a question for the Bank of England. And I'll tell you about our forecast rather than theirs. It may be, although I'm not sure about this, it may be that we look at the energy futures a little bit further down the road than the bank use in their forecast, so we get this kind of drop off that they don't factor in. I'm not entirely sure that's true. That may be a factor. And we probably have a slightly weaker forecast in wage inflation. But again, that's kind of more a question for the Bank of England than for us, perhaps.
Do you want to comment on that?
It's probably worth us saying one thing about how we've done our inflation forecast this time around compared to on previous occasions, which David may or Andy may explain better than me. But one thing we've done is reweighted our CPI forecast over time to reflect the fact that the composition of household consumption changes as prices change, because you have to consume more energy in your basket when it's more expensive, and then you consume less of it when energy comes out. Usually, we don't adjust the CPI basket over the course of the forecast because we assume the composition of household consumption is essentially unchanged over the 5 years, or at least hard to predict. It's now much easier to predict how it's going to change because the price of some commodities and necessities is going up very much. That ends up giving more weight to inflation in the near term, but then it gives as those things fall and they have more weight in the basket, that then drags inflation down at least for a few years. because their prices are falling. And that may be another explanation for why we've got lower inflation and actually negative sort of deflation for a few years compared to some other forecasters, because we're actually trying to anticipate how the ONS is going to recalculate inflation over the 5 years rather than just assuming a constant basket.
Thank you. We've got about 10 minutes left and still loads of questions online, so we'll enter the sort of quick fire phase and see what we can do, but I'm sure we'll leave some people disappointed. We'll go to Sue Chan, who asks, the government decided to protect increases in benefits for families and pensioners. Who will pick up the bill for this? Do you expect its decision to freeze the threshold for employer NICs contributions to lead to fewer jobs being created? So I think that's a couple of questions there.
In terms of who is paying for the energy crisis, I mean, as I said in my remarks, the whole country as a whole is paying for the fact that energy prices are higher. All the government can do is decide on the distribution of that pain between taxpayers and between people who benefit in some way from the state, and as well as government departments, and then current and future generations through borrowing. So the pain is going to have to be borne by the country. We are less well off as a result of the fact that a necessity we rely on is more expensive. In this particular fiscal statement, taxes have been raised on the principal beneficiaries of these price rises, who are the energy companies. There have been reductions in departmental spending, so they are paying some costs, and there are freezes in tax thresholds. So there are more income taxpayers and more higher rate taxpayers in this forecast than previous ones. The group that has been, in essence, protected are people on the basic state pension and people on index-linked, inflation-linked benefits, because those are being uprated fully in line with the rise in inflation.
Thank you.
On the national insurance question, so employer NICs is often described as a tax on jobs, but actually the evidence is it's a tax on wages, and as that tax goes up, it's passed through to the employee as a lower wage, and that is reflected in our forecasts.
Brilliant, thank you. So we're going to go to Jeff Tiley now, who says, you stressed that GDP outcomes would be worse but for government support. Given you forecast falling inflation, is it right that more government support would have made GDP outcomes better still?
It's the case that government support in the near term, I mean, the government is providing about £100 billion of extra support over the next 2 years. That means that, based on our own estimates, that means that the depth of the recession that we're facing ends up being 2% rather than 3%. So it's a 2% fall rather than 3% fall. It does stand to reason that if the government were to spend more, you might have a slightly smaller trough. But in the end, as I said, we are adjusting to what is, in essence, a price shock to the UK economy as a whole, and a shock to the supply side of the UK economy, to which demand eventually has to adjust. So there is only so much government can do to smooth that adjustment. It does some smoothing by spending the extra money over the next 2 years, but we still face a 2% downturn in output overall.
Thank you. Have we got any in the room? If not, I'll keep soldiering on online. Okay. A couple of questions on welfare spending, so I might come to you, Andy. Andy asks you, can you say something on the increase in welfare spending? 19 billion's a lot, isn't it? And I have lost the other one. It was from Kitty Usher. There we go. Do the tweaks to welfare policy announced today have a measurable impact on labour supply forecasts?
Okay. The year-on-year rise in welfare spending next year that's driven by the 10% inflation rate is a large increase. It's not one we've seen for many, many years. And I don't think there's a lot more I can say than that. Without knowing specifically which welfare policies it is, there are among the welfare policies that have been announced today. One is to change the boundary between whether someone receiving universal credit is treated as a intensive work claimant and therefore has lots of contact with work coaches or not. We have not in this forecast changed our employment forecast off the back of that. So in a sense, we will await the evidence of that and factor it in as it appears in the data.
Thanks, Andy. A couple of broader questions online. Josiane Kakao asks, any reason why we didn't have your assessment of the previous mini-budget? And Kathleen asks, what is UK budget responsibility? Independent judgment is fine, but why is so much of UK economic policy opinion rather than logic? I will ask you to answer those, Richard.
I think the short answer to the first question is that we weren't asked to produce a forecast for the mini-budget, and under legislation it is for the government to decide whether they want a forecast to accompany their fiscal statements and whether those forecasts get published. And in neither case was that the case for the mini-budget. It's also the case that, as I pointed out, there were 5 different fiscal statements made since March, and this is the first one that has had a forecast accompanying it. And this has become something of a pattern in British fiscal policy making, that major fiscal announcements get made without an economic forecast, without a fiscal forecast accompanying them. Sometimes there are good reasons for that. There's a crisis, necessity demands it. But in the case of the mini-budget, we were not asked to produce a forecast.
Thank you. I'll give everybody in the room one last chance to put their hand up. No, I think
Sorry, we've got one from Anna.
Sorry, Anna.
I just wanted to try again. Is 61.7, is that the biggest fiscal consolidation that's ever been pushed to the end of a forecast? Is it the biggest single one?
Andy's memory may be better than mine.
It is a very large single fiscal event tightening. 60 billion in this one. So if you remember back to June 2010 and the coalition's first government, the additional fiscal tightening they announced was 40 billion. And if you factor in the larger economy now, they're probably pretty similar numbers. But the difference is that this fiscal consolidation is announced against a backdrop of the March forecast that it certainly had higher taxes, but not rising taxes in the medium term. And it had pretty stable public spending as a share of GDP. The coalition's first budget was announced against the backdrop of very substantial fiscal tightening that they had inherited from the outgoing government. So I think roughly 115 billion of overall tightening, because they inherited a consolidation that was twice as large as the additional measures they took. So in that sense, it's not on the same scale as what the coalition embarked on, because they were, in a sense, doubling down on what they inherited.
Great. I think we've got time for one final question. And it's online. Someone says, is the new fiscal target to cut borrowing to 3% of GDP the laxest there has ever been? How many different sets of targets have we now had and largely broken?
We've had very many fiscal targets since the idea of fiscal rules came to this country in the late 1990s. 3% of GDP is probably close to being one of the laxest. In previous iterations, you've had rules to balance the current budget, but the government's never managed to spend 3% of GDP on investment, which meant that that didn't imply running a 3% of GDP deficit. So it is relatively lax compared to certainly George Osborne's old rules, where he was actually trying to balance the budget bang on, so zero deficit. And it's also more lax than trying to balance the current budget, given that we only invest about 2 to 2.5% of GDP these days. And indeed, Rishi Sunak's old rules to balance the current budget are still being broken in our forecast. It's also the case that meeting fiscal rules is pretty rare these days. I think there's only been 1 or 2 years in the last decade where fiscal rules were actually being met. But I think you also have to take into account, we've had a financial crisis, a pandemic, and an energy crisis, and these are difficult environments to operate rules-based policy. So you do have to also have some sympathy for the people who have to make the decisions necessary to try and meet these rules.
Thank you, Richard. That's all we've got time for this afternoon. Apologies to all those online whose questions we didn't get to. We're very happy to follow up with you afterwards or take requests for supplementary information. And I'll wrap up by saying thanks to everybody for joining us, and we look forward to seeing you at our next event in the new year.